The legislation I'm signing today rolls back the crippling Dodd-Frank regulations that are crushing community banks and credit unions nationwide. They were in such trouble.
Some Democrats are blaming former President Trump's partial rollback of Dodd-Frank regulations for the collapse of Silicon Valley Bank.
Unfortunately, the last administration rolled back some of these requirements.
But is deregulation really to blame? The answer isn't so simple. Dodd-Frank was passed after the 2008 financial crisis, in part to better regulate the large banks that helped cause the Great Recession. In 2018, then President Trump signed a law that changed some of Dodd-Frank's requirements. Specifically, mid-sized banks were no longer subject to the toughest regulations around liquidity and risk management.
In 2018, Republicans in control of the House, they go ahead and the Democrats join with them, many of them 30 Democrats in the House, 16 in the Senate, and they roll back these capital holding requirements. So this was preventable, both through better regulation and, frankly, through better decision-making at the bank.
Those bank CEOs who lobbied hard to get this change in the law, those are the ones who, when the window opened, wow, they decided to load up on risk. And why? They loaded up on risk because it made their banks more profitable.
One of the things that happened when they rolled back those regulations was it allowed banks like SVB, because of their size, they're no longer big enough to take these stress tests. I don't know that if they were regulated like they were before the change would have forestalled this problem, but it certainly couldn't have hurt.
But the role deregulation played in Silicon Valley Bank's downfall is hotly contested.
At the end of the day, we had an old-fashioned bank run. And we have bank runs. If we didn't have bank runs, we wouldn't have the FDIC. We have deposit insurance to protect depositors when and if we have bank runs. And so when you have a bank run, it means that depositors want their money back. These banks all passed their high-quality liquid asset test, which is a ratio of how much cash you have on hand to what is the statistical probability of how much cash will leave the bank.
And they all passed.
They all passed.
If you look at Silicon Valley Bank's annual financial filings, they were saying in pretty clear words what they were doing and some of these dumb risk management decisions that they were making, that they weren't hedging against the expected rise in interest rates. I think some of this stuff maybe should have been caught even without the obscure technicalities of a stress test.
The federal government has stepped in to guarantee deposits to assure bank customers that their money is safe, underscoring the importance of containing the fallout. In the meantime, sources say the Department of Justice and the SEC are investigating the exact cause of the collapse.